In this video, you'll learn 8 ways rich people make money with inflation. So, let's begin. Currently, the US is experiencing an inflation rate of 3.67%. This is an uptick from the 3.18% observed last month, though it's significantly lower than the high of 8.26% from the previous year. Despite the current rate being above the long-term average of 3.28%, it's crucial to understand what this means for consumers and investors. As inflation increases, the buying power of money decreases. In simpler terms, your dollar today might not stretch as far tomorrow. This trend affects everyday consumers because goods and services become pricier, making it harder for them to maintain their standard of living. Investors, too, often face diminished real returns on their investments due to inflation. However, not all investors find themselves on the losing end during inflationary periods. Surprisingly, some see this period as ripe for opportunity. Their secret? They strategically allocate their investments to assets that historically prospered during inflationary times. And for those wondering where to place their money during such times, I'm about to give you 8 places. So like and subscribe, and let's get into the video. Asset number 8, gold, silver, and precious metals. Silver and gold are precious metals treasured for their value and have been used as currencies for centuries. Even today, they have maintained their status as solid investment options. The appeal of these metals as investments often shines brightest when traditional currencies, like the dollar, are losing their value, especially during inflationary periods. You see, but during inflation, when the value of money diminishes and commodities generally become pricier, precious metals like silver and gold tend to maintain their value. Historically, gold has outperformed silver during inflation. However, it's worth noting that gold typically comes with a heftier price tag, being around 70 times more expensive than silver. Investing in both metals might be a good idea to optimize returns and minimize risks. If you're considering investing in silver or gold, you can explore these 2 options. First, you can directly buy silver or gold in forms like coins, bars, or bullion. However, this approach has its challenges. Authenticity is crucial. Without adequate expertise, you might risk overpaying or acquiring counterfeit products. Alternatively, you can invest in exchange-traded funds that follow the value of these precious metals. This method is generally less risky because you're indirectly investing in the metal via a professional fund. Plus, with this approach, you don't need to worry about storing the physical metal. Asset number 7, various commodities. When inflation rises, commodity prices often jump up, offering an enticing investment opportunity. However, investing in commodities isn't a surefire win. Their prices fluctuate based on supply and demand, meaning you can gain or lose money. Successful investment in commodities heavily relies on timing. For instance, raw materials like oil, grain, and cotton have seen price increases in recent years. A notable example is oil's price surge following the Russian invasion in February 2022. Those who invested in oil right before this spike enjoyed substantial profits. Similarly, due to supply chain disruptions caused by the pandemic, while demand for wood remained steady, its price soared, leading to significant gains for some investors. Most commodities, unlike gold or silver, have a shelf life. For example, it wouldn't make sense to buy large quantities of perishables like avocados, hoping to sell them at a profit later. A practical approach is to invest in exchange-traded funds that track specific commodity indexes. You can benefit from price increases without worrying about the commodity expiring. Asset number 6, cryptocurrency. While not a widespread choice among the rich, some wealthy individuals are venturing into cryptocurrency. Unlike traditional currencies, this digital form of money uses a technology called blockchain to track transactions. Though it's relatively new and more complicated than other investment methods, it has attracted attention due to its potential returns. Cryptocurrency's resilience against inflation is still being evaluated, but 2 main factors make it intriguing. 1, its limited supply. Mining or creating new cryptocurrency units is resource intensive and doesn't always guarantee immediate benefits. This limitation means the market doesn't get flooded with excessive new cryptocurrencies, which helps maintain the value of existing ones. Secondly, no government or financial institution oversees or controls cryptocurrency, unlike regular money. This independence means it's free from traditional market influences, which can lead to both higher risks and higher rewards. While diversifying into established investment options is advisable, sprinkling a bit into cryptocurrency could offer significant returns if you accept the risks involved. Asset number 5, Treasury inflation-protected securities. Treasury inflation-protected securities, commonly called TIPS, is a kind of government bond you can buy for terms of 5, 10, or 30 years. Like regular Treasury bonds, TIPS pays interest to investors twice a year. Here's how it works. If you buy a TIPS bond worth $1,000 with an interest rate of 0.3%, and after a year, inflation rises by 4%, the value of your bond increases to $1,040. So instead of just earning $3 in interest, the total growth of your investment, considering the inflation adjustment, becomes $43.12. The unique thing about TIPS is how it responds to inflation. Not only does the primary bond value adjust with inflation, but the interest you receive also changes accordingly. The best time to buy TIPS is before inflation kicks in. By doing so, you can fully benefit from the increasing bond value and the rising interest payments when inflation climbs. If you wait too long and buy them after inflation has already set in, you might find your investments have already declined in purchasing power. TIPS are a solid choice for retirees looking to keep their money safe. They protect your principal amount from the negative impacts of inflation, ensuring that your savings maintain their value over time. So TIPS are worth considering if you're interested in a low-risk way to diversify your investments. You can purchase newly issued TIPS directly from the U.S. Treasury with a Treasury Direct account. This is typically the cheapest option. If you'd rather not go through the process yourself, you can also purchase TIPS from a bank or investment broker. Asset number 4, savings bonds. The U.S. Treasury offers savings bonds known as I-bonds with 2 types of interest, a fixed rate and a rate that changes based on inflation. This interest rate is reviewed and adjusted every 6 months according to the latest inflation data. For instance, as of now, the composite rate for I-bonds issued in May 2023 is 4.30%, and this rate is locked in until October 2023. The rate may go up or down come fall, depending on the economy's health. I-bonds offer both short-term and long-term investment possibilities. While an I-bond will grow in interest for up to 30 years, you aren't tied down for that long. You can cash out the bond after just 1 year. But be cautious. Cashing out before the 5-year mark means you'll lose the last 3 months of earned interest as a penalty. However, after holding onto the bond for 5 years, you can cash out without any penalties. Asset number 3, stocks. Many people in the US, especially the wealthy, choose to invest in stocks. However, there's a catch. While you can earn a lot, you can also face significant losses. If you're unsure about navigating the stock market, it's wise to seek advice from experts at investment firms. When prices are expected to go up, most rich individuals look for ways to shield their wealth. One favorite choice is utility stocks, which come from companies providing essential services like electricity and gas. These stocks are attractive because the companies often share some of their profits with investors, creating a steady income called dividends. The good thing about these companies is their ability to adjust their prices when costs rise, ensuring they remain profitable. Another safe bet during inflation is stock index funds. You can find these as mutual funds or exchange-traded funds. They represent a collection of companies, for example, those in the S&P 500. By investing in such funds, you're putting your money in various companies at once, which lowers risk, especially during inflation. Plus, it's often more affordable than buying shares in each company individually. Asset number 2, debt. Some people don't like having debt, but sometimes debt can be helpful. When the price of things goes up, certain kinds of loans can protect your money. One example is leveraged loans. These loans can adjust their interest rates. So, if inflation happens, they can increase the rate to match the rising prices. Most wealthy people consider mortgage-backed securities and collateralized debt obligations. These are like containers that hold many different loans inside. Instead of directly owning the loans, they put money into these containers. However, investing in mortgage-backed securities, collateralized debt obligations, or leveraged loans can be complex and carry risks. They might also need an enormous amount of money to start. So it might be easier for a regular person to invest in mutual funds or ETFs, that specialize in these income-generating products. Asset number one, real estate. Most wealthy people invest in real estate, like houses or apartments. These properties often grow in value when overall prices in the economy go up. This is because everyone needs a place to live. This demand ensures that real estate usually appreciates. There are different ways to put your money into real estate. One option is owning rental properties, where you earn money from tenants paying rent. However, for those who prefer not to deal with the day-to-day management of properties, the other option is through real estate investment trusts. These are companies that own income-generating properties ranging from malls to apartment complexes. By purchasing shares in these companies, you can reap the benefits of real estate without the associated management responsibilities. While history has shown that real estate can perform well, especially during inflationary periods, it's essential to understand that there are risks. If interest rates go up or there's a financial problem, like what happened between 2007 and 2008, the value of real estate can drastically decrease. Thanks for watching, have a great day, and see you in the next one.